financials are by far the best performing sector this year. The KBW Bank Index is up 20% year to date, compared with 15% for Standard & Poor's 500 stock index. It's no coincidence that banks' profits have also increased at a faster clip than other sectors' earnings. But analysts expect financial firm earnings to slip by nearly 2% in the third quarter. If profits tick down, does that spell trouble for bank stocks? Here to share his outlook for the financial sector is David Ellison, manager of the Hennessy Large Cap Financial and Hennessy Small Cap Financial Funds. Both funds are rated 4 stars by Morningstar and are up over 31% over the past year, compared with roughly 28% for other mutual funds invested in financials. Dave, welcome to the program. It's nice to have you.
Good to be here. How are you?
Doing well today. Given the run-up so far this year and depending on your outlook for profits, do you chase financials here, or is it time to get cautious?
Well, I think the reason why financials have done well the last 2 to 3 years has been the recovery in housing that's accelerated, and we've seen that pretty evidently this year. And that's helped credit, it's helped loan growth, and I think if that continues, the group will continue to do well. So I think housing is a critical part of this. Housing is, potentially under some pressure with rates, but I think there's enough pent-up demand that we'll be okay.
What's your outlook for earnings in the third quarter? As I mentioned in the intro, the consensus is for earnings to slip. Granted, it's going to be somewhere around 2%, but what's your take?
Well, I think the earnings decline that the analysts are looking at are really driven by the slowdown in the refinancing activity, because rates have gone up enough to slow that down pretty dramatically. But I don't really look at that as the way I view it, as this is an industry that has gone through a significant down cycle. Obviously, we've seen all that, and we've watched it and reported on it and had to live through it. But now we're really still in a healing process and a repositioning process. And earnings don't matter that much now, in my opinion. They're making money, they're taking that money and throwing it against the balance sheet, repairing themselves. So it's really about setting themselves up for the next 5 to 10 years, not the next 3 or 4 months.
So then valuations look pretty attractive to you right now?
Well, historically they are attractive. The large cap companies trade at a modest premium to book and between, let's say, 10 and 12 to 13 times earnings. And that historically is very cheap. But the real issue is that there is a tremendous amount of getting better that's going to happen over the next 3 to 5 years as they reposition the assets and the liabilities. And that takes time. It took time to build up the problems that created the problem, and it's going to take time for those problems to be taken care of as they earn money through the next couple of years.
Dave, what does the Fed's unwinding mean for the banks? Will rising longer-term interest rates, as we've seen recently, while the Fed keeps the short end of the curve anchored, will that help boost banks' net interest margins?
Well, the process will happen slowly one way or the other. I think rates going up generally is, I feel, a good thing. Yes, there are some negatives of housing, but basically the banks are sitting on a tremendous amount of cash at zero yield, and any move up in rates will allow them to redeploy that at a higher yield, get a better spread, or even get a positive spread and make more money. So the banking industry has been hurt by low rates, because they're basically in the business of lending it out. And if they're lending it out at a very low rate, it's very low profit. So profits are going to rise in that respect. And the question now is, how does housing respond? How does the market respond? And how does the economy respond? Right.
To your point, depending on how much interest rates rise from here, would you expect loan growth to pick up as loans become more profitable?
Well, that's the question. As I say, that's why we keep coming to work every day. The reality is that we've had low rates for a long time, and now rates appear to be moving up. Is that going to help the economy or hurt the economy? The textbook says that, rates go up, that should hurt the economy. But of course, we had a 30-year bull market in bonds, and that really didn't help us 4 or 5 years ago. So to put it in perspective, when I started at Fidelity back in 83, Fed funds were 18%. Now they're effectively zero. So a lot has changed in 30 years. So I suspect that the next 30 years are going to be a lot different for this industry and for the economy for that reason alone.
Yeah, and to your point on banks trying to find new sources of revenue, I have in my notes here that since you think the 30-year bull market in bonds is ending, and that was an area where a lot of banks earned a lot of profits, not to mention that now with dodd-frank, the Volcker rule is going to be implemented, and that prevents banks from trading for their own account. That means they're going to have to look for new sources of revenue elsewhere, right?
Well, I think that you're correct, but there's another side of the story, which is basically there's also a ways to cut expenses. And so I think there's two sides of the argument. People say, well, just because they're losing money in this business doesn't mean they're going to be in it. So what you're seeing out there is when you talk to the companies, and even in the press release, the press releases, they talk about, not only headcount reductions, they talk about salary readjustments, people being reoriented with the organization. And so there's a lot going on internally at these companies that is going to, in a sense, bear fruit down the road. And you and I can't really see that. But if you look at the big companies, the top 3 or 4 companies, they all have, 6,000, 7,000 branches. They've got, $2 trillion in assets. They've got, $2 trillion in liabilities. All these things need to be reworked and reoriented toward a different rate environment, a different regulatory environment. And the people and the managers that do that the best are the ones you want to own. And that's what I'm trying to do for the shareholders.
Yeah, before we get to which names you like within the industry, I want to come back and drill down on your thoughts on rising rates and the impact on housing. I know it remains to see how this is going to play out, but if you look at some of the housing data in July, we are seeing mortgage demand come down a little bit. To your point on refinancing, those have come down. Both Bank of America and Wells Fargo laid off collectively 3,000 workers in their refi divisions. I mean, what impact does rising rates have on banks' mortgage businesses?
Well, you've already seen the impact, and you just laid out some headcount cuts, and a lot of that's refinancing. And I think the issue really is what's the true demand for housing. But I think more importantly, the good news here is those loans that are being made the right way. They've got they're doing all the work. They're making sure the documentation's correct. They're making sure the person actually has a job or has the ability to pay the mortgage. So these are good loans that they're making versus 4 or 5 years ago or 6 years ago when they really weren't paying a lot of attention. It was all about who had the most volume. So fundamentally, the industry is in a good place with that respect. So I'm not too worried about growth because remember we had all that growth 8, 9 years ago. Guess what happened? Didn't work out so well.
Right. So then coming back to which stocks you like within the financial sector space, I mean, do you like asset managers here? Do you like regional banks? Do you like the big money center banks? What are your favorite picks?
Well, because of the transformation of the industry, it's hard to sort of pick 1 or 2 names. What I'm telling people is I like a lot of assets and a lot of heads, meaning that I want a company that has a lot of assets that they can rework and improve the returns on those. And I want somebody with a lot of employees that you can either adjust the headcount or adjust the salaries or adjust the bonuses. So that leads me to names like, Citicorp and JP Morgan and Bank of America, names like that, even the larger regionals like SunTrust or Regions, because they have that flexibility over the next 5 or 6 years to do all of this stuff internally without needing a much stronger economy. So, they don't need 4% GDP growth to generate the returns that we're going to see improve over the next 3 to 5 years.
Point well taken. Dave, thanks so much for coming on the program. We'll have to leave it there. Hope to see you soon.